Viduka Scopi TV, I'm Alex Isaac, looking at the week ahead with CIBC's Nick Exarhos. Nick, what do you see as the main market event this week?
I think geopolitics will be at the forefront this week, obviously with the events unfolding in Ukraine regarding the retrieval of the victims of the Malaysian Airlines crash, and also the events unfolding in the Middle East with Secretary of State Kerry traveling to Cairo today. But note that the events in Ukraine really highlight that some of the previous economic sanctions imposed on Russia are sort of countermeasures that have a longer fuse, and I think that the current events will put pressure on Western partners to implement the strategies and put pressure on Russia that have quicker effects to resolving the crisis in Ukraine. And with Kerry traveling to Cairo, Egypt was an instrumental partner in arranging a ceasefire in 2012. But note that new President al-Sisi recently removed the former President Morsi, who is part of the Muslim Brotherhood, which has pretty close ties to Hamas. So this time around, it might be more difficult to arrange a ceasefire through an intermediary like Egypt. So that might have a spillover in sort of creating more geopolitical risk tensions going forward.
The conflict in Ukraine has taken quite a dramatic turn. Could the tension have a long-lasting effect on the worldwide economy?
Well, in terms of relations with Russia, I think we saw earlier this year Russia arrange a deal with China supplying close to 40 billion cubic meters of natural gas over 30 years, worth around $400 billion. So already, I think, on Russia's part at least, I think they see an opportunity to diversify away from the European export market. And I think for the Europeans, sometimes I think the current crisis will bring to their attention that they have sort of diverging interests to Moscow, and I think they will try to find alternative import sort of sources for their energy needs. Note that Germany's dependence on Russian oil and gas is quite substantial, right? At over 30%. So I think they'll need to sort of diversify away from that going forward.
Nick, looking a little further long term, BMO Capital Markets has suggested that the Canadian dollar will slump. Do you agree? And what may cause this? Well,
we've conducted recent research that shows that the real neutral rate in Canada depends in part on the level of the exchange rate, and that at a higher level of Canadian dollar strength would imply a lower neutral rate in Canada. So at the current level of the Canadian dollar, it would imply that the Bank of Canada would probably miss a hike or two that the Fed would engage in. And we see that scenario starting in the second quarter of 2015, when we predict that the Fed will undertake a first hike to 25 basis points on the Fed funds rate. That the Bank of Canada will miss. We'll begin the process of weakening the Canadian dollar towards 115 on dollar CAD by the mid-2016.
And finally, do you have any concerns for the week ahead?
Well, obviously we have the geopolitical concerns that we spoke about a little bit earlier, and we also have the rest of the earnings season. And note that the S&P is just shy of its all-time high, so we'll see if earnings strength, with 70% of reporters already beating consensus expectations on their earnings. And we'll see if that strength there will be able to overpower geopolitical concerns and push the S&P through all-time highs.
Thank you, Nick. For more in-depth analysis of what's making the financial news this week, be sure to check in with Dukascopy TV. Goodbye for now.